Right, good morning to all. We will let about 1 or 2 minutes first to get all the participants to dial in before we start. Right then, a very good morning to all. On behalf of Bursa Malaysia, I would like to welcome and thank you to all participants, as well as our honorable speaker, for taking your time to be part of this Bursa Malaysia IR4U Series 4 webinar. So for today's session, our speaker will be sharing his outlook on how the global economy may perform despite Trump's tariff measures, and also the spillover effects on rates, foreign exchange, and also specific markets in Malaysia. So before we start, let me introduce our speaker for today, Mr. Barnabas, Group Chief Economist of RHB Banking Group, is a seasoned market strategist and economist with over 15 years of experience covering global and ASEAN markets across most asset classes. So Mr. Barnabas has also served the Singapore's Prime Minister office in a research and advisory role for Singapore policymakers, being recognized as a top analyst by Bloomberg and Focus Economics. His research has been cited by prominent organizations, namely the ASEAN Development Bank and also Current Economics. For some housekeeping rules for all participants, kindly type in your question in the Q&A box, which we will address it upon completion of the presentation. So without further ado, I would like to pass the floor to our speaker, Mr. Barnabas. The floor is yours.
Thank you, Puan. Good morning, everybody. Thank you for taking the time to listen to RHB, as well as our views for the global markets. My name is Barnabas, Group Chief Economist for the bank. And really, unfortunately, we are meeting in extremely volatile and uncertain times. And I think probably the views cited today is subject to change, especially when policy has remained, to be very, very volatile and uncertain. The only thing that maybe perhaps is certain is that there may be more uncertainties to come into the global economy into the next, 3 months, if not 6 months of the year. So today's presentation, I will share my screen very quickly. Today's presentation is actually being titled as Leopard in the Grass. Just can I have a shout out from Puan Aiman? Can you guys see my screen?
Yes, we can see your screen.
Thank you.
Yeah.
Thank you. Yeah, so today's presentation is titled Leopard in the Grass. So the summary really is this. I think our key conviction is really for US tariffs to continue to escalate into the second half. There has been some reprieve from the global arena whereby Trump has injected exemptions from electronics, smartphones, and what is important really is this: he may have de-escalated tariff risks from the global arena since early last week, but the problem is there still remains to be a 10% universal tariffs from the global perspective. And really more importantly, if you could recall, during his election campaign, Trump has cited his plan to inject a 20% tariff on the rest of the world. Yeah, and of course a 60% tariff on China. So what we are trying to say really is this: the risk, the tariff risk at hand is not over. There will likely still be more noise to come, that from a policy making perspective, from tariff perspective, and I think probably there may still be a need for some risk aversion or some, buy into defensive asset classes, especially from now to say the end of second quarter, if not third quarter. Yeah. So I think probably we think that the market relief, it will likely be short-lived, given that there will likely be a elevation of tariffs into the third quarter when the 90 days reprieve, the postponement of the tariff over the course of the 90 days, it's over. And we do expect that the US administration might come in to re-inject tariff noise again into the third quarter. So that will be something to watch for. Yeah. Bottom line is that the action that we may have to take is now, not later. Especially when there may be some clarity of further escalation of tariffs. By the time we wait till then, it might be too late. So there is a need to act now and to act swiftly in order to navigate the market uncertainties in a more prompt, and efficient manner. That's point one. Point two really is that really into the second quarter of this year, we do not discount further downside bias for US equities. Yeah, the reprieve might come in, the exemption of tariffs might come in, but towards the end of the second quarter of this year, we do expect that there may be further sell-off in equities, especially when market starts to price in further tariff risk into the third quarter. Yeah. So the need to preempt this sell-off is largely required. Yeah. So probably the next strategy would be to sell on rallies, especially from risky assets such as equities. Yeah, on that front. So we do not discount that US equities could see another 5 to 10% downside into the third quarter of this year. Yeah. Probably the next thing that we should actually be concerned about is if there is going to be a sell-off in equities and further downside bias for equities, where should we park our money in? Where should we put our money in? Yeah, so to speak. One key consolation that we have is that since the start of this year, my research has actually cited that there is a need to stay defensive and to stay overweight on fixed income. And this view has materialized very well in the first quarter of this year. Essentially, one of the key outperformers in the global setting has been fixed income, and that has been a very good play. We think that this strategy will continue to play out, at least in the second quarter. Essentially, it means that we should continue to stay overweight on fixed income. Yeah. And that is also on the basis of further downside bias for rates. And that will be one of the key drivers for fixed income valuations to increase, given that rates are falling, are likely to decline into the pan of this year. Yeah. We are downgrading GDP forecasts across key markets given the tariffs. As I mentioned earlier, we do not hold any comfort from the exemptions of the tariffs. And that basically gives us a very strong sense that, look, we have to stay cautious for the year, and of course, when we hear what Janet Yellen has mentioned in an interview just yesterday, she has actually mentioned that there's a risk of further downside bias to the point of recession into the US. And I'll speak about recession risk later, but essentially right now, we do engage a slew of GDP downgrades across key economies. For GDP for the US, we have downgraded to 1.5, but there is a very strong balance of risk towards 1%, given where tariffs are going at the moment. For China, we are exceptionally much more bearish. We do not have any confidence against or basically on China's growth target of around 5%. Yeah, we all know that the MPC has actually mentioned that GDP growth for China is estimated at around 5% for this. So we don't think that's going to happen. We think that the continued tariff risk against China from the US will drag Chinese growth to 4%, if not lower. Yeah, and the only assumption for the 4% growth this year has to be based on monetary policy support that could take place. Yeah, for Malaysia, I will speak about more later, but of course, there will be a very marginal downgrade of 4.5%. I think maybe at this time, it's good to also point out that Malaysia's economy remains very resilient. We ended the year very well last year at around 5.1% annual growth. And this is a very strong performance compared to the rest of ASEAN in 2024. In 2025, at least in the first quarter of this year, we are looking at about between 4.8 to 5% growth, if not higher. And that is also a testament of Malaysia's growth, GDP growth, and its economic resilience in 2025. The only reason that we are downgrading is really probably due to the sense of caution and probably due to the exposure of trade that Malaysia has in terms of the E&E sector in the economy itself. Yeah, so we are downgrading our GDP forecast from 5%, a marginal downgrade, yeah, to 4.5 for this year. Our modeling basically also suggests, that if you are looking at, say, a potential negative output gap in the US in the second half, vis-a-vis potential upside bias for inflation, all things accounted for, the Taylor's rule that we have adopted, and this is most likely one of the models that the Fed actually uses as well, to try to gauge what is the appropriate interest rate regime, in the US. This Taylor's rule that we have modeled on our own still continues to reinforce our forecast for three Fed fund rate cuts in 2025. Yeah, and this is actually in line with what the markets are calling for. It has been downgraded from 5 rate cuts to current 4. So I think the markets, especially the traders, are actually pricing in around 3 to 4 rate cuts for the year. We do think that that is a likely basis, probably towards 3 rate cuts. And for anybody who wants to know when the rate cut is going to come in, we think that probably the first rate cut will likely be seen as early as June this year. So June one time, September one time, and December one time, and that could mean, say, a 3 times cut for the US Federal Reserve. This would then be important for, FX rates, DXY, the dollar strength, and we do think that the year-end DXY forecast will be going to around 101 to 102 for the DXY. Currently, it's about 99, almost 100. This is because of the very huge pricing in of the rate cuts, around 4 or 5 rate cuts currently at this stage. Yeah. So once market starts to move back to the 3 rate cut cycle, do expect the XY to strengthen a little bit in the near term, but overall weakness will still likely happen at around our forecast range of 101 to 102. And this basically means that the ringgit will be about 4.2, 4.3 from a correlation perspective per dollar by the end of this year. Yeah. For Bank Negara, given the uncertainties at hand, we still remain quite confident that Bank Negara will likely keep its OPR, this overnight policy rate view unchanged at 3% for the year. But the thing is that we do see a very small balance of risk for BNM to actually reduce its OPR by 25 basis points on one very strong assumption. And the assumption would be if growth dynamics weaken very strongly to below 4%. Yeah. And of course, as I mentioned just now, with the FFR cuts to come in and OPR to likely stay unchanged, that will mean that the ringgit will be at about 4.2, 4.3 per dollar by the end of this year. Okay, so I've taken some time to speak about the executive summary. Let's just go to the slides at hand and see how we can navigate these current market uncertainties. So these are forecasts, as I mentioned, 1.5% for US, and for China at 4% with downside bias. For Malaysia is at 4.5, for Indonesia at 4.5 for 2025. And of course, for the other ASEAN economies, Singapore and Thailand will be at 2%. Yeah. Inflation is largely unexciting except for the US. Our models essentially shows that US will hit inflation to 3.5 or higher. So that's why we are pricing our inflation forecast at 3.5 for the US. But for the rest of ASEAN and for the rest of the rest of the economies that is being shown on this table, there are conflicting you know, drivers or factors that might, determine how prices may move. On one hand, there may be supply chain congestions, and higher, and higher tariffs would mean, higher prices into the global arena. Excuse me. But the problem is that when China starts to realize that they can't sell to the US, then there may be an increased supplies into the rest of the world. Yeah, and that could mean lower producer prices. And of course, if growth starts to come down, then demand-led conditions will also deteriorate, and that could place a dampener on price pressures. And that basically essentially means, that their ex-US, probably the inflation dynamics might stay quite tame despite the tariff, issues. For the US Federal Reserve, as I mentioned, we are looking at 3 rate cuts. So hence, we are looking at maybe a range of between 3.5 to 3.75, another 2 more rate cuts in 2026. Yeah, and that will bring Fed fund rates to a range of 3 to 3.25, 3.25. Yeah, and for the rest of ASEAN as well, I think that Japan might see further hikes towards the 1%. And really, Japan is actually probably the only economy that is different, whereby they are on a hiking cycle rather than on the rate cut cycle, by the rest of the other economies. For China, we may be looking at about between 50 to 75 basis point cut in this LPR, and that is really on the basis of trying to support its growth, given the tariff risk against China itself. For Indonesia, we're looking at 5%, about 3 rate cuts. Malaysia at 3. Thailand is also about 2 to 3 rate cuts. That will bring Thailand's BOT rate to about 1.5%. Essentially, what we are trying to say really is that look out for lower interest rates dynamics into the course of this year. So this will bring our forecast, for the FX into where we are seeing right now. As I mentioned, DXY about 101 to 102 by the end of this year, and that will actually spill over to some of appreciation bias for the rest of the world. And Malaysia will be about 4.2 to 4.3 by the fourth quarter of this year, 4.286 to be precise, based on correlation analysis and our perception of risk premiums within ASEAN itself. For those who are looking at the yuan, probably the appreciation of the yuan might be a little bit muted, about 7.3, very close to where we are, right now. This is really because that some of the DXY weakness, if it happens, might be countered by the downside bias for Chinese growth, and that means that the currency might stay, relatively stable toward the course of this year, and vice versa for the rest of the other economies. Okay, so what we are trying to say really is this. At the start of the year, we have been advocating, the strategy of overweight bonds, and that basically by itself has actually allowed us to say, look, global IG bonds are one of the key winners. And this has played out very well into the course of the first quarter. And as mentioned in the executive summary, we think that this strategy should continue and also still persist, probably in likely overweight quality bonds, quality bonds, and that could mean that IG bonds in general could continue to stay supported. Some downside in bonds valuation for some who are in the markets right now, maybe wondering, why has bond valuations or maybe gold valuations have declined, and that really is also because of the fact that there may be, some sell-off, some profit taking within these spaces, in response to the downside in equities. Yeah, it's a natural phenomenon. But I think on a general note, continue to stay cautious, stay wise, stay prudent, in basically looking at quality IG bonds as one of the key safe haven or quality buys into the second quarter of this year, if not third quarter. We can see the MSCI World has actually, declined very sharply, and this has been really on the basis of the tariff risk. And as I mentioned, this will continue into the third quarter, especially if Trump continues or the US administration continues to re-inject tariff risks into the global arena. Our proprietary numbers basically suggest, this are RHB risk sentiment index that has been built. It basically leads the S&P by 2 quarters, and this have been a strong underpin modeling capabilities within the research team itself in trying to give external clients and external viewers such as yourself a very strong clarity of how risk-taking or how equities might perform, especially in a very short term, about 2 weeks. And unfortunately, the sentiment index, which actually leads the S&P by 2 weeks, has actually declined very sharply to risk aversion, to risk averse territories. And this basically means, in a nutshell, likely to have more profit taking or more, not profit taking, more declines, pardon me, on the S&P or global equities valuation into the next 2 weeks. And that might be extended into the second quarter of this year. Our heat map, and essentially for the US economy, has actually been largely on a mildly negative side. If I may just add, what the key takeaway from this release, that recession pressures, the last line as you can see on the heat map, has suggests that the recession pressures or recession risk in the US is slowly climbing. Yeah, it's now currently, based on the data at hand, the recession risk is about 55%. And we are seeing this, global markets are also seeing this, they are seeing the same thing. And this essentially means that if this continues to happen, if recession fears continue to stay elevated or grow into the coming months or into the third quarter, and that will reinforce the risk aversion that could actually take place over the same period of time. Yeah, but suffice to say, it's a mildly negative print. We just have to wait and see if the pressures, recession pressures, as well as the tariff risks translate into the real economy, and it is slowly doing so at this current juncture. Yeah. So what are global market participants doing? And this is important. Yeah. We may listen to a slew of economists analysis, research analysis, but the key important takeaway is what investors are doing. Yeah. We can safely ignore all the analysis in the world, but we cannot ignore what global markets are doing. And what global markets are doing is that there are continued shedding off of equity exposures towards the course of the year to date in 2025, and that is an essential print that we should look at. Yeah, and prior to the sell-off in bonds, as you can see, as I mentioned, the sell-off in bonds is likely due to profit taking in response to the sell-off in equities. But essentially, before the sell-off, we can see that market participants have generally moved away from the equity exposure into the bonds exposure, into the fixed income exposure, especially quality ones in the DM space. Yeah, we can see the huge uptick before the decline. Yeah, but this huge uptick essentially has corresponded with the very down, the plummet, in both DM and EM equities over the same period of time. Yeah, and this has further reinforced our view for investors to move these exposures away from equities and likely overweight fixed income, and this should likely continue into the course of second quarter of this year. The poorer US growth dynamics is of course mirrored by the FOMC. I mean, the most recent FOMC statement basically suggests that there will be a downgrade to US growth, not only for this year, but for the 2 years to come. Yeah, so 1.7% in 2025, 1.8 in 2026, and 1.8 again in 2027. What they are looking at most importantly, and this is a very, very pertinent point for investors at hand, is that the upgrade to the inflation forecast, it's only isolated in 2025. And this is an important point and a pertinent point, simply because this suggests that inflation risk in the US is transitory. It's temporal, it's tariff-based, it's only isolated within 1 year. And this is important for policy making because economic tenets or economic theories have proven and showed us that policy making and policy moves, policy tweaks, especially from the monetary perspective, has to be made on a persistent inflation or real economic changes or impact, not transitory. And if we can conclude that inflation risk is transitory, it basically plays out to the point that the Fed may continue to cut interest rates, even though inflation is picking up just in 2025 alone. Yeah. So we can see that the fund flows have been very strong into the US, but it has come down very sharply already as we speak. Yeah, this may continue, and the Fed funds, especially as of today, is still pricing it about between 3 to 4. Yeah, as what we are seeing right now. Yeah, whereby the swap pricing is leading towards the 3 rate cuts by the end of this year. Yeah, and our Taylor's rule analysis, as I mentioned, suggests 3 rate cuts. Yeah, this is really on the basis of the output gap, whereby we are pricing in a negative output gap and a transitory increase in inflation. Yeah, and we have to account for the word transitory, and this basically suggests 3 rate cuts. Yeah, even though inflation spikes and we price in a narrowing US GDP output gap to the point of it being negative into the second half of this year. Okay. So where should we go if we are believing in, say, more rate cuts for 2025 for the US? There may be less rate cuts by the ECB. The yen, BOJ is hiking. There may be if there is some support in commodity prices. If there is, yeah, probably not. But the RBA may be cutting less than the US. And of course, Indonesia's rates are actually way higher compared to where the US rates are, currently if the US cut rates. So what is the carry return, or what is happening from the FX carry space? The point is that the dollar carry is fading. A good part of the rally in dollar back then in the late part of 2024 has been due to the Trump factor or Trump trade. I think everybody knows it's the Trump trade. So when Trump is about to be elected as president, investors were looking at the US with a more bullish light, with a more positive light, and that could actually mean and have injected some rally in the dollar. We didn't believe in that. We have adopted a view that the dollar rally back then is temporal, and it came to pass. And this is really because we have priced in that the fading of the dollar carry will happen. So if this dollar carry is fading, given the lower rates that we are likely to see into the end of the year, which currency will benefit? Yeah. So first and foremost, probably the yen. Yeah. The yen, as I said, the BOJ is on the hiking cycle. This means that the BOJ might lift interest rates further, and due to the interest rate differentials, this basically means that the yen will be the one of the key outperformers in 2025. So this basically explains that the negative carry, the negative US dollar carry against the yen is the strongest. Yeah, followed by the euro. I think it's also because of DXY, a biggest part of the DXY is actually priced in the euro. That's one. And second, probably the ECB is also is being perceived to be cutting less than the US, and that also has given euro some of the upside bias in the most recent times. Yeah, and same thing for the sterling. For the lower commodity prices, that has been a very strong drag, especially on Aussie. So that's why the long dollar against the Aussie still remains to be quite high. Why? Because if China slows down, commodity prices may slow. China remains to be one of the largest, if not the largest, consumer of raw materials and commodities, base metal, crude oil, you name it. And this means that if Chinese growth starts to decline, commodity demand starts to decline, and Aussie, or also Kiwi for that matter, based on its correlation with base metal prices, will mean that lower base metal prices will be negative for Aussie and Kiwi, and hence the dollar carry or the long carry, analysis still remains to be quite favorable towards Aussie and Kiwi. Yeah, Indonesia has its own issues at hand, so I won't go into details. But for those who look at Indonesia or more so Thailand very closely, there has been domestic issues within these economies itself, and that had caused them to be one of the key underperformers year to date for the FX space at hand. Yeah, so I think watch out for key pertinent US labor markets, and this will be one of the data that especially myself I'll be looking at very closely. Labor conditions in the US have weakened. Okay, call a spade a spade. Some analysis, some analysts came, has made. I've been reading that has said that there may be a downside. That non-farm payrolls have normalized lower, which is true from post-COVID, and they are approaching normal, levels. I agree. However, this doesn't explain that unemployment rate has climbed. Yeah, and the fact is that the decline of the NFP, has actually been translated to a higher unemployment rate of 4.1. And for those who have read the news just yesterday, there's a huge resignation within the IRS in the US. And that may, and if that continues, that it blows up to other, government payrolls and spill over to the private sector, there may be a continued phase of labor weakness in the US, and that is very pertinent for policy making in the US. And one of the other key variable that we look at, especially for myself, is the unemployed to job openings ratio, which is shown on this chart itself. It's still below 1, so that's good. Below 1 number basically suggests that there is actually more job openings than unemployed people. Yeah, the amount of job openings in the US still remains to be more compared to the number of unemployed or jobless people. This will likely change. It's creeping up and it's actually approaching 1. And if it blows above 1, if it goes above 1, this basically means that the story will change. And how we change it? We basically will change from more unemployed people, more jobless people on the streets looking for jobs, as compared to the very limited vacancy numbers in the US. And that is likely going to be this will likely be problematic for US labor conditions into the year ahead. Yeah, and if you look at the manufacturing numbers in US, if tariff risk starts to go in again, just to expect probably some weakness in manufacturing new orders because prices has gone up, cost has gone up. There are some news saying that iPhone prices will go up, further. Some say above towards $6,000 per phone. I don't know, but essentially this is the understanding behind prices and manufacturing manufacturing activities in the US itself. So what are the downside for US industries if we do have exposure in Malaysia? Looking at the US, given that US is one of the key export markets in Malaysia itself, looking at the US, if these US industries will suffer, there may be negative spillover effects into Malaysia shores or ASEAN shores in general. So these are probably the downside bias, manufacturing and this machinery and transport, given that these are the key products that are exported to Canada and Mexico from the US, and of course towards China as well. Machinery and transport, chemicals, crude materials that are actually one of the key exports, from US to China. And of course, with the increased risk at hand, since the start of the year, we're already seeing some slowdown in export numbers to China. It may be due to the Lunar New Year. It could also be due to demand has declined, and the momentum, which is being defined as a month-on-month, 3-month moving average, has also declined quite sharply as well for both exports to the US and China across ASEAN. I think some key consolation perhaps really it's that the manufacturing momentum has slowed into the year end, but it still remains supported. But I think we have to look at it very closely. E&E related exports has slowed into the end of 2024, and I think eyes will be very concentrated on potential elevation or escalation of US-related trade tariffs on semiconductors, and this will be one of the key considerations for ASEAN growth and export markets in 2025. Inflation is boring, as I mentioned just now, so I think that inflation momentum has declined. I think for Malaysia as well for the rest of ASEAN, there are still drivers for softer inflation into the year, and that by itself would be one of the key consolation and comfort perhaps that maybe prices may not run away despite the slowdown in growth. So that is the confidence that we do have really at the current moment. So let's move on to Malaysia. Perhaps we do have our own models as well in terms of how Malaysia might grow into the course of this year. We do have our leading, model, and this is being regressed and being modeled through the use of big data, leading indicators, and regression, tools and skills that we have, and we have came out with the RHB, leading index for GDP, the RHB lay, and this actually does lead the real GDP growth in Malaysia by about 2 quarters. And as of now, given where we stand, we are confident that the first quarter number for Malaysia should be comfortable at around 4.8 to 5% year-on-year growth in the first quarter of the hand. And that is important because this first quarter growth in Malaysia, hasn't accounted for the tariff risk that basically escalated into post February and March, and it hasn't accounted for the tariff risk. But more importantly, the strong growth at about 4.8 to 5%, at least from what I speak to investors, if you could just imagine that Malaysia is a strong ship, but in choppy waters. Yeah, strong ship essentially suggests that Malaysia's fundamentals, Malaysia's economic fundamentals remain strong, labor conditions remain, healthy, and with the export markets as well as the domestic indicators, such as the manufacturing activities, export growth, and the various, domestic indicators still remains to be very bullish and positive for Malaysia. The only reason as to why we are downgrading is simply because of the choppy waters. Yeah, and this choppy water is not, I repeat, not it's not isolated to Malaysia. It's actually being done as being seen across ASEAN itself. Yeah, and the constellation that we have, a very strong constellation that we have, is at least towards the end of last year and into the first quarter of this year, we remain positive on Malaysia's growth. Yeah, and we can see that Malaysia's PMI, if you can see, it has also been one of the key. It has grown and recovered much more from a stronger perspective as compared to the rest of ASEAN, including Singapore. Yeah, the rate of growth in the PMI, and that itself is also a consolation as to why Malaysia, the ringgit has been one of the strongest, if not the strongest, in 2024 across ASEAN, and it has been also a testament of why investors look at Malaysia with a more positive light compared to the rest of ASEAN itself. The thing is that towards the course of this year, the sell-off in Malaysia's equities as well as bonds has continued. Yeah, so I think this is one thing that we should look at. There may be some momentum recovery in the equities towards probably 2 weeks ago. Yeah, but it has sharpened. It has gone down sharply again into year to date. And this, as I mentioned, is not isolated. It's not isolated in Malaysia. For both equities and bonds, the outflows remains to be quite stark in Malaysia shorts itself. We are comforted, hopefully, that the exemptions might continue, and that could actually be supportive of Malaysia's exports. We can see that the exports have been very much supported by both petroleum and E&E in Malaysia itself. So that's good. Yeah, and of course, if you can see the export destinations, to Singapore and EU has remained to be supportive of Malaysia's, external environment as well. But the risk is at hand. if there is going to be an escalation of tariff risk, then we should look at Malaysia's export exposure to the US. Yeah. And really, unfortunately, we can see that the huge exposure has remained to be the E&E, and machinery like electrical machinery and parts. If you look at, say, the B divided by A as a potential, B as in the US, and A is total exports. If you see the share of total exports of US from share of total exports by this electrical machinery and parts is about 16.7%. Same for the other E&E related, such as office and data machines, 24.5%, telecoms about 44%. We also have apparels at 35%. And while doing this table, I have learned something new, that almost 50% of Malaysia's furniture goes to the US. Yeah, so something to some trivial facts that we have learned from this. Yeah, but I think essentially, if we look at the general aspect at hand, the key downside bias, if tariff escalate, will be on these industries. Same for China as well. If China growth starts to slow down, then we will have to see what is the export exposure to Greater China. And for Greater China, we have to account for Hong Kong, because Hong Kong is the export, base for China itself. Yeah. So if you look at, say, B divided by A, yeah, so China and Hong Kong on a cumulative basis, B as compared to A, which is total exports, we can see that the key export markets remains to be the same, quite similar. Yeah, E&E again, yeah, electrical machinery and parts at 26.9, almost 27%. Of course, there's energy as well at about 23%. Remember the export graph that I showed you just now, whereby the exports has been very much supported by petroleum and E&E, and this is being explained by the energy component right here, about 23% to China. Of course, crude materials as well, say non-ferrous metals at 28%, some chemicals at 23%, crude materials again, plastics at almost 40%, and of course some vegetables and oils at about 40%. Yeah, so just take note of this potential downside bias, especially if escalations continues from the tariff perspective against Malaysia. Yeah. I am cognizant of time, so maybe I just go on a bit quickly for Malaysia's tariff sensitivity analysis. I think one thing that we should see is really that Malaysia is now a recipient of direct tariffs, and we are actually about 2.1% of trade deficit with the US. But the thing is that if we see the total exposure, we can stay slightly comforted that most of Malaysia's trade exposure has been concentrated across ASEAN at 26%. We have to take to regard the downside bias or second order effects from China, but at least most of Malaysia's, or ASEAN in particular, export market still remains to be intra-ASEAN. And this basically gives a very strong sense as to why ASEAN as a body, as a bloc, has to stay united, stay cohesive, and be one voice in the current markets right now. And this basically underpins the importance of ASEAN as a region, especially in today's trade uncertainty in the global arena. I shall skip some slides, but if we just go on to the conclusion at hand for Malaysia's trade and GDP, I think one of the key effects really is that if you are looking at, say, the tariff against US from China, US tariffs on China, at the point of time was 60%. We are calling for about 0.7% decline in Malaysia's GDP, and hence that's why we have downgraded Malaysia's GDP from 5% to about 4.5%. We hope that the impact will likely be milder than what we are seeing right now. Why? Because of the exemptions. Yeah, hopefully it doesn't escalate. But if we do see the exemptions continue to persist, then perhaps the downgrade to GDP will be maybe about 4.5%. Yeah, and if you look at, say, 100% tariff, one point to note is that there is no need to look at tariff beyond 100%, because the impact will be very similar towards 100%. You just imagine if the US places a 1,000% tariff on China as compared to 100%. Yeah, the Chinese market can't sell. Will not be able to sell or export its markets, its products to the US. once tariff rates hit above 100%. Yeah, so if we look at just say 100% on China, tariff on 100% on China, then perhaps Malaysia's decline to GDP could be as much as 1%, given this table at hand. Okay, let's maybe just skip a few slides. And we can see maybe on the investment exposure, Malaysia sees most FDI inflows from Singapore. The impact to China is very small. The impact from the US is also very small, and that basically means really that we are looking at probably that investment exposure still remains to be intra-ASEAN as well, similar to trade for Malaysia. And for tourism itself, for tourism, some of the risks probably at hand that people may be looking at is that if Chinese growth starts to slow, then perhaps Chinese tourists into Malaysia may start to slow as well. That may be true, but the point is that Chinese tourists as a market to Malaysia's tourism market is small at about say 91.1. This probably the number of persons at this print. I think this print is wrong, but the number of persons really from a monthly perspective, will be at around 100 at 100,000, on a monthly perspective in terms of tourism arrivals from China. But the point is that Singapore remains to be the largest market for Malaysia itself. And this is, of course, Singaporeans crossing the causeway into Malaysia to to enjoy the cheap ringgit as well as the cheaper prices in Malaysia itself. So thanks to our neighbor Singapore, that has actually caused and basically supported Malaysia's tourism market over the course of the 3 years. Okay, let's just move on very quickly to the Leopards. Yeah. So I think the presentation title is Leopards in the Grass. Yeah. And probably I have to explain why the title is Leopard in the Grass, because the risk basically really is that leopards are camouflage, and then essentially we have to point out where the downside risk is when we finally see the risk at hand. And I think back in 2018, we have actually seen that the tariff rate back in Trump 1.0 was only about 2.3%. Yeah. And with the recent Trump tariffs, it has actually brought up to the total import tariffs at about over 20%. And that is actually 10 times more compared to where it is right now. Yeah. Back then, in 2018, the FOMC actually mentioned, that the 2.3% tariff assumed will have the potential to depress US GDP growth by about 0.2% and boost consumer prices about 0.15%. So if you just do a very simple, calculation in your head, if the tariff rate is 10 times current, previous tariff rate, 10 times, then the impact might be 10 times as well. And that basically means that the US growth might fall by as much as 2 percentage points. Yeah, so 0.2 times 10, 2%. Leopard 2, yeah, that's Leopard 1, yeah? Leopard 2, maybe the impact to US inflation will be very stark. We see that Chinese exports as a percentage of total, US imports from China as a percentage of total imports is around 14-15%, yeah? 400 billion compared to 3 trillion. So if you look at really the model at hand, I won't go line by line, but the inflation upside for US, it's 3.8, if not higher, towards 4%. Yeah. Leopard number 3 basically is that if we are going to see higher reciprocal tariffs revisited with a vengeance into the third quarter, then perhaps we may be seeing further downside risk for growth, yeah, for 2025. So these are our downside worst case scenarios for the growth, for the rest, for the global markets. US, if that happens, probably we might be looking at between 0 to 1%. For Europe, we are seeing a recession, -1. Japan will be 0, and China will fall to as low as 2%. Yeah. For the rest of the ASEAN, we can read off the charts. Then perhaps the worst case scenario, yeah, this is not a base case. The worst case scenario, if the unexpected happens and risk and tariff risk escalate beyond our expectations, then the downside bias for ASEAN will be quite stark as well. Leopard number 4 is that if this will play out, yeah, if there is going to be a very strong, huge downside bias for the US. However, if inflation picks up very sharply above 4%, then we may not be seeing rate cuts at all. Perhaps maybe rate hikes. And that is maybe a very, very strong and tail end risk if inflation starts to rise very sharply beyond 4%. And that is actually bad for growth, but the Fed might re-engage the focus to combating and ensuring price stability within the US shores itself. And that will mean rate hikes in 2025. Yeah, Leopard 4. And probably the last leopard will be China. I think that perhaps if you see Chinese domestic issues, the China-centric concerns are still weighing. There are still downside bias for home prices within China. We are seeing that net fund flows out from China remains to be quite strong. Yeah, and of course the debt issues in China are climbing across all debt structures, yeah, household, public, corporate, are climbing, and it has actually surpassed the key indices for the rest of the other regions, such as EM as well as advanced economies, and that is actually not a good print, especially for Chinese debt levels, especially when the debt and interest rates, more so interest rates, might decline into 2025, and that may exacerbate debt accumulation in China itself. Okay, and maybe the model itself does show that maybe if you're looking at, say, a 60% tariff, this will have to be revisited already. But just on a 60% tariff, we view that Chinese GDP will decline by 3%, if not lower. And that basically suggests why we are looking at about 4% growth for China on the basis of monetary policy support. Okay, I am towards the end, so I think the slides are likely to be shared on Bursa's website, but I just want to share probably two key newspaper articles clippings. One is the 5 scenarios that might happen, and maybe another article that I wrote whereby I have mentioned that Malaysia's chairmanship in its ASEAN space will be a very strong catalyst for transformation, and the reason as to why we need to stay cohesive as a bloc itself to combat and navigate the current uncertainties in the global arena. So thank you so much, everybody. I'm happy to take any Q&A right now as we speak. Thanks.
All right. Thank you so much, Mr. Barnabas, for the insightful sharing, which I believe has been gotten so much attention from our audience for today. So if we start addressing a few questions from the floor. So the first question will be on, will the US Federal Reserve rate cut result in an inflow of funds from global investors into ASEAN markets or Malaysia?
Okay, so the question was, will rate cuts by the US result in an inflow of funds into Malaysia? The rate cuts, okay, so let me break down the question. Rate cuts has to be performed for various reasons. If there are going to be rate cuts on a positive news, yeah, then perhaps fund flows will continue to flow into Malaysia. However, what we are looking at right now is that rate cuts by the FOMC, it's on the basis of poor economic prospects in the US, and the rate cuts, if happen, will be used as a policy tool to support growth on the basis of slow growth, on the basis of lower growth prospects in the US itself. And if we are going to translate this to say, slower growth into the rest of the world, then perhaps there may be continued outflows from Malaysia shores, from the equity space, because there will be risk aversion. Yeah, there may be a continued reallocation of funds away from equities into fixed income or into safe havens, and that may mean that probably the equity space from the global arena might continue to stay neutral to negative from the tariff risk, and maybe the key strategy is to remain to be overweight, especially on defensive asset classes such as safe havens and quality fixed income.
Right, and thank you. Okay, looking at the current situation, will this be more detrimental for the US citizens compared to the other nations?
Will this be more detrimental to US citizens rather than China? Uh, I think this question requires a little bit more context. Let's just break down the question one more time. Yeah. If we are looking at the 145% tariff on China from the US, let's just play out some other key variables at hand, whereby if US airlines continue to see only a 10% tariffs, or most of the rest of the world are only seeing a 10% tariff, then perhaps the US might be successful in trying to isolate Chinese growth and Chinese markets away. The US remains the biggest consumer of global goods, and as such, the allocation of trade away from China to the rest of the world could mean benefiting the US, in terms of the trade divergence away from China into the US. So that's one. However, if you're looking at further escalation of protectionism into the US, then probably long-term basis, one thing that we should note really is that economic theory suggests that protectionism doesn't play out in the long term. It doesn't benefit the economy in the long term, because US industries face or benefiting those industries that benefit from protectionism in the economy itself have to rely on further protectionistic policies to survive. And this means that the cost of production or labor costs and the various fundamentals at hand within the industries itself are actually supported by the protectionist policies that if it gets removed into the future, these industries will not be able to compete in the global arena. Yeah. So probably maybe just look at it from a more short-term to long-term basis. Short-term, maybe US citizens might, or more so the US markets or the US economy might benefit, from this this protectionistic policy at hand. But from the medium and long-term perspective, we may be seeing that the US protectionism be more detrimental to industries rather than benefiting them. Yeah. Thank you.
All right. Okay. So moving on to the next question, maybe in your view, why is stagflation unlikely to occur as a result of Trump's recent tariff hikes?
Maybe I didn't state it clearly. Stagflation is actually our base case. Yeah. So the stagflation is basically defined as higher inflation and lower growth. Yeah. And as throughout the course of this presentation, I have already mentioned that US inflation will rise to about 4%, 3.5 to 4%, and for US growth to actually decline towards 1.5, if not 1%. So just to clarify and state it clearly, stagflation is our base case scenario from Trump's recent tariff hikes. Thanks.
And thank you for the clarification. So in the worst case scenario, how will a US recession affect Malaysia's GDP?
So in the worst case scenario, if you're looking at, say, further reciprocal effects into the world, and if US starts to re-inject the reciprocal rates that was seen before the exemptions happened, one key direct hit will be, of course, the US, whereby we are looking at US growth to be between 0 to 1%. Yeah, but we have to also account for the slowdown in demand conditions, investment conditions, and increased supply chain, challenges in the global space. And all things held constant, given Malaysia's exposure to the US and China, as well as to the global markets, we think that probably Malaysia's growth could actually decline to as low as 3.5%. But just let me clarify that this is the worst case scenario. It's not our base case, and this is a illustration of how bad it can happen if there is an unexpected increase in tariff risk into 2025.
All right. Okay, Mr. Barnabas, we have seen that the technology and growth sectors has been highly impacted by these Trump policies. And you also have been talking about these defensive stocks that we can focus on. So any other sectors that you may suggest? And maybe if rates will be also affected in the long run?
So basically, the question is which sectors will benefit
Yeah.
from the tariffs, from the tariffs. I think maybe in the short term, perhaps we may be looking at potential benefit, especially from the finished goods industries. Finished goods industries. Why? Because our key exports has always been on E&E, and of course, a key exports really from Malaysia is also finished goods, and that basically means that if Chinese exports of raw and semi-produced, goods might not be exported to US if demand for this goods starts to decline in China because of the shortfall in US demand, then this means that China has to sell somewhere. And one of the markets could be Malaysia or ASEAN in particular. And this means that input prices, manufacturing costs might decline given slower or lower or more so higher supply for that matter of such goods. And this means that probably the margins of productions might actually widen for Malaysia's producers in the short term. But just let me clarify, it's probably short term. Into the longer term, if tariff risk continues, then perhaps there may not be any winners. Probably the only winners perhaps is safe havens and quality assets in particular, just like how we may see in a typical recession during the GFC and the AFC, whereby winners are actually very rare, and most of the industries across ASEAN have actually deteriorated from crisis periods.
That's very understood. So maybe the last question, in regards of the currency, like, do you think that the dollarization effects, dollarization efforts would be multiplied, reflecting the current development?
Okay, short and sweet answer, probably yes. Yeah. The de-dollarization efforts have continued for a longest time. And we are already seeing that, say, the share of the use of the dollar to command global trade has fallen as compared to where it was, say, 20 years ago. Yeah. And the currency that has replaced the US dollar in dominating global trade has been the yuan. The overall protectionistic policies that that the U.S. economy is advocating right now, and perhaps the examples that we have seen in past crises, probably the fear is that the reliance on the U.S. industries and on the reliance on the U.S. dollars and the exposure of trade has been one of the key reasons as to why the rest of the world goes down together with the U.S. when there is a U.S.-centric crisis. So what does this mean? This basically means that if there is going to be further protectionistic policies that might be advocated in the US, then perhaps efforts to have cross-region, cross-currency trade within ASEAN itself, and we've already seen this really between Malaysia and Thailand, and that is basically and there may be also there is also efforts between Malaysia and Indonesia as well, cross-currency trade, and that has been one of the key reasons for the de-dollarization, trends to actually continue into the medium term. So yes, the answer will be yes. Yeah.
Okay then. So I guess we can take the very last question. So any outlook on the gold prices, which have given the record high recently?
Okay, so our base case is for further risk aversion to continue. Our base case is for tariff risk to continue. And that basically means that maybe gold prices as a safe haven might continue to rise. Yeah. So I think perhaps we are already seeing that gold prices have actually gone up and came down again. But perhaps if we are seeing risk aversion to continue, we do not discount that gold price might actually go up to as high as 3,500 per ounce in dollar terms by the end of this year.
All right then. Okay, thank you so much again, Mr. Barnabas, for your time and expertise. And also thank you to all participants for the engaging session. As for the presentation slides and webinar recording, it will be uploaded on our IR4U site, and please find the link in the chat box. With that, we thank you for all that participating today, and please stay tuned as well. We will bring a more under IR4U banner for 2025. Thank you and have a good day ahead. Thank you, Mr. Barnabas.
Thank you very much for the time.
Yeah, thank you. Did I see that then this